IFRS standards are international financial reporting standards (IFRS) that consist of a set of accounting rules that determine how transactions and other accounting events are required to be reported in financial statements. International Financial Reporting Standards. Accounting Standard IFRS-1. September 2007, IASB published the revised IAS-1 to provide guidance in the following. IFRS. IASB stands for International Accounting Standard Board, which is handling IFRS. So in simple, we can say all IFRS are framed by this IASB. IAS, International Accounting Standard, are handled by International Accounting Standard Committee. International Accounting Standard (IAS) and International Financial Reporting Standard (IFRS) are the same. The difference between them is that IAS represents old accounting standards. If I say IAS-1 or IFRS-1, the meanings are same. IFRS have taken place of IAS. This IFRS-1 provides the guidance in the following areas. Number 1. Purpose of financial statements: to provide information for decision-making. Decision-makers can be creditors, investors, suppliers, government entities, and all those who are interested to get the information. Number 2. Components of financial statements. Number 3. Overriding principle of fair presentation. Number 4. Accounting policies. Number 5. Basic principles and assumptions. Number 6. Structure and contents of financial statements. Let's go to discuss each component of IFRS-1. Our first component of IFRS-1 is Number 1. Purpose of financial statements. As you know, the purpose of the financial statements is to provide information for decision makers. This information can be helpful for creditors, investors, suppliers, government entities, and for all those who are interested to get the information. Number 2. Components of financial statements. The component of financial statements comprises a full set of financial statements, which are as below. A. Balance sheet. B. Income statement. C. Statement of cash flows. D. Statement of changes in equity and notes. E. Summary of significant accounting policies and other explanatory notes. Number 3. Overriding principle of fair presentation. Financial statements shall present fairly the financial position, financial performance and cash flows of an entity, that there always will be clearance and fair presentation about financial position, financial performance and about cash flows of the entity. Fair presentation requires the faithful representation of the effects of transactions, other events and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income and expenses set out in the framework. That always there will be correct and fair presentation. If transaction is related to expense, it should has to go in expense account. In same way, if have pay amount for asset, always will go under purchase of assets account. And in same way, if his pay amount against liabilities, should has to go in correct account. Compliance with IFRS generally ensures fair presentation. Fair presentation. In the extremely rare circumstances when management concludes that compliance with the requirement of a standard or interpretation would be so misleading that it would conflict with the objective of financial statements set out in the framework, IAS-1 requires departing from that requirements, with extensive disclosures will be made in the notes. Disclosure can be on any of these components. If local regulatory framework will not allow departing from a requirement, disclosures must be made to reduce the misleading aspects of compliance with that requirements. Number 4. Accounting policies. Management should select and apply accounting policies to be in compliance with all IASB standards and all applicable interpretations. If guidance is lacking on specific issue, management should refer to. Number 8. The requirements and guidance in other IASB standards dealing with similar issues. Number B. May you need or can contact with the Advisory Committee of IFRS for more clearance and interpretation. Number C. The definition, recognition and measurement criteria for assets, liabilities, income and expenses set out in the IASB framework. Number D. Pronouncement of other standard setting bodies and accepted industry practices to the extent but only to extent that these are consistent with A and B, do not conflict with other standards. For accounting policies, you can go to check IASB International Accounting Standard Board, IASC International Accounting Standards Committee, IASB Framework, IASB Interpretation, and other standard-setting bodies. IAS-1 does not indicate that this is a hierarchy, that you can go with best prevailing option. Must need to follow the IFRS. If do not have required information, then can go to any other option. Number 5. Basic principles and assumptions. Accrual basis. Hopefully, we know that in accounting we use accrual basis accounting, not cash basis. That when any expense or income is incurred on same-time transaction is recorded, whether we didn't received and paid the amount. Going concern assumption. We assume that company will exist forever. We have looked long-term prospective for the company. That is the reason we amortize the premium. We depreciated the assets. We amortize the discounts. We assume company will be there in future. Consistency and comparative information principles. There always should be consistency and comparative information that we have to provide. The comparative information in the framework that comparability goes hands in hand. Consistent that by applying the same principles that our financial statements are more comparable. Immaterial items should be aggregated. Always immaterial items should be aggregated in the financial statements. Offset of assets and liabilities, income and expenses. Assets and liabilities and income and expenses should not be offset and reported at a net amount, unless specifically permitted by standard or interpretation. Just keep in mind no offsetting is allowed. Structure and contents of financial statements. IAS-1 also provides guidance with respect to 1. Current, non-current distinction except when a presentation based on liquidity provides information. 2. Items to be presented on the face of the financial statements. Minimum items to be disclosed in the notes. Profit before tax must be reflected using either the nature of expenses format, commonly is used in continental Europe, or a function of expenses format, commonly found in Anglo countries. Either option is good. We can represent profit before tax IAS-1 specifically precludes designating items as extra on the income statement or in the notes. This is a basic overview of the IFRS 1 for your easy understanding. Thanks for watching. If you like this video, please thumbs up, share this video and subscribe my channel for more useful videos.